Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. In this episode, we are going to discuss how UK-bound M&A activity is poised to stand out in 2023 as overseas buyers seek attractively priced British assets and the resulting impact that has on the deal terms we're seeing in the market. I'm Beatrice Lo, a corporate M&A partner in Latham & Watkins' London office. And I'm joined by Jennifer Cadet, who's also based in London.
Thanks, Beatrice. So glad to be here.
So, while the start of 2023 has seen global M&A deal volumes dip, one of the key trends we are seeing is increased UK-bound M&A, given how attractively priced UK assets are, and particularly for US dollar buyers. And with more US buyers active in the UK market, we're starting to see an impact on deal terms as US buyers seek terms which tend to be more common in the US market than traditionally in the UK. Jen, would you agree with that?
Yes, absolutely. The U.S. private M&A deal terms have historically been viewed as a bit more buyer-friendly than those in the more seller-friendly UK market. And this is particularly true with respect to deal certainty and post-closing recourse. So with increased interest from U.S. buyers of UK assets, it's super important for buyers and sellers to understand both UK and US expectations of deal terms. This will help them find solutions to dealing with issues like deal valuation, certainty, and recourse concerns.
Right. So let's take each of those areas in turn. So starting with valuation, the US and UK markets have tended to have different approaches to valuation and the transfer of economic risk. So here in the UK, we typically see deals featuring what we call a locked box mechanism, which fixes the purchase price on an agreed date based on a set of accounts. And this generally transfers risk to the buyer from that date, but sometimes you also see negotiated ticking fees, which reflect cash flow generation between signing and closing.
In the US, so we contrast that with completion accounts. And so those are mechanisms which are used to adjust the final purchase price after completion of the acquisition based on a set of accounts as at the completion date and adjusted for items like cash, debt, and working capital. Under this mechanism, the seller retains the operational benefit of the business until closing, but also the ongoing costs of funding the business and related operational risk. So I think UK sellers should expect US acquirers to ask for completion accounts, and US buyers should be aware of a typical UK seller's expectations. Given these different approaches, if a UK seller is focused on using a lockbox structure, they should be ready to deliver recent audited financial statements or otherwise have accounts prepared that buyers can confidently rely on. On the other hand, we have seen US buyers on tight timelines be successful in pushing for completion accounts on the basis that it's less work up front to agree the locked box accounts that you would be required to have for a UK style transaction.
Yeah, agree with that. I'm actually expecting the prevalence of locked box mechanisms to decrease further this year if we see more US acquirers who favor completion accounts, particularly outpacing UK PE firms. And where locked box mechanisms are used, I think we are going to see more focus on ticking fees, particularly given global complexity and timelines for M&A, antitrust, and regulatory processes, which we are expecting also continuing to increase. So let's move on to closing conditions then. So that's another aspect where I think UK and US deal makers do tend to take different approaches. And in my experience, I've seen US acquirers often requiring a lot more conditions to close a deal. Jen, what's your experience?
Yeah, I think that's right, Beatrice. And this is because in US transactions, deal and business risk is typically not transferred until deal completion, whereas in the UK and Europe, we see business risk typically transferred to the buyer upon signing of a deal, assuming satisfaction of any regulatory or antitrust conditions. With increasing numbers of US acquirers in the UK market, UK deal makers should expect to discuss a wider range of deal conditions than they had on prior deals. Common conditions which must be satisfied before a deal completes in the US would include a requirement for the seller's reps and warranties to be materially accurate at completion, material compliance with interim covenants, as well as the absence of a material adverse change, or a MAC clause.
So you mentioned material adverse change, or MAC clauses, which give a buyer the right to walk away from a deal in the event of a material adverse change to the target business. Other than for certain industries, like in the energy sector, where I see that quite often, I don't typically see MAC clauses included in a UK deal.
Yeah, I agree that MAC clauses are certainly far less common in the UK and in the US. For example, our recent M&A market study found only 12% of UK deals included a MAC clause compared to 98% of US deals. And although it is common in US documentation, a MAC is seen as a truly significant and sustained adverse change in the target's business, which isn't known or anticipated by the buyer as of signing. And given that there is such a high threshold, US courts rarely find that a max existed. Instead, US buyers are able to walk away from acquisitions following the target's failure to satisfy a closing condition, or there could likely be a connection to a material breach of an interim covenant, or where a materiality standard other than a MAC applies to a breach of warranties by the target. So, as more US buyers are entering the UK market, MAC clauses may become more common in US deals. Yet, given the deal certainty remains crucial, UK sellers can expect to resist these requests by MAC clauses, particularly on competitive deals. Instead, sellers can rely on market precedent in Europe and scarcity of case law in the UK as to what may signify a MAC event. Finally, on this point, if UK sellers do agree to a more traditional US conditionality construct, they should focus on compliance with covenants and accuracy of warranties to make sure that they're able to meet those standards at closing.
Interesting. So let's move on to post-closing economic risk allocation then. I think historically commercial warranties were the key tool in both US and UK deals for understanding and allocating risk. But that is changing quite a bit, isn't it, Jen?
Yes, in the US, we have public style or no recourse deals, which have become more common in highly competitive M&A markets. These provide private sellers with risk protection levels similar to what we would see in a public deal, and essentially means that buyers won't have recourse against the sellers after closing for any breaches of reps, warranties, or pre closing covenants. In the UK, buyers' ability to seek recourse post closing has also narrowed, though this trend remains a little bit more deal dependent. Competitive deals have seen buyers accept a limited or sometimes nominal level of seller recourse by way of warranty protections. Regardless, parties generally make exceptions to carve out obligations that are performed following closing or for claims of fraud.
I agree with that. And where we do have sellers not willing to stand behind warranties, warranty and indemnity insurance has become a much more common feature of UK transactions. However, I think that's changed a little bit recently, where we have started to see buyers really critically evaluating the merits of taking out a W&I policy. And some instead will accept that while they have no recourse against the seller, they might decide not to take out W&I and choose instead to spend the premium costs elsewhere.
Yeah, I think that's right. In the US, where we typically call it rep and warranty insurance, the use of RWI has increased significantly over the years. PE buyers have migrated towards a no recourse structure backstopped by RWI in most transactions, for example. US strategic acquirers have similarly moved towards a no recourse or limited recourse structure, and these generally will permit claims for breaches of fundamental representations and or for some portion of the deductible under an RWI policy. However, that's probably not the case for many strategic acquirers in the US who remain focused on more traditional US remedies, such as seller indemnification and escrow obligations. And these acquirers often frame this as part of their willingness to pay a significant premium for an asset, or the sellers need to retain perceived post-closing accountability. So given the kind of ongoing market uncertainty, we're seeing both UK and US market practice starting to pull back from recent heavy focus on no recourse transactions. And I expect parties are likely to land on a bit of a hybrid recourse package.
That's super interesting. I think over the next 12 months, we are going to see more significant transatlantic deal making opportunities. And we at Latham are certainly looking forward to continuing to support our clients in navigating transatlantic deal terms and guiding them to a successful transaction. Jennifer, thank you so much for joining us today and sharing with us your experience and insights into the US and UK deal practices.
So glad to be here. Thanks for having me.
And to our listeners, thank you for joining us for this episode of Connected with Latham. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or wherever you normally get your podcasts. If you would like more information about any of the topics we discussed in this podcast, please do email us using the links located in the show description. We hope you'll join us again next time. Thanks very much.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.